Thank you for standing by and welcome to the Universal Biosensors 2018 half-year financial results call. All participants are in listen-only mode. There will be a presentation followed by a question and answer session. If you wish to ask a question, please press the star key, then 1 on your telephone keypad. I would now like to hand the conference over to Mr. Rick Leglater, CEO. Please go ahead.
Thank you, Jane. Good morning, and it's my pleasure to welcome you to the Universal Biosensors first half 2018 results presentation for our fiscal year ending 31 December. My name is Rick Leglater, and I'm UBI's Chief Executive Officer, having been appointed to this role in October of last year. I'm joined on the call by my colleague, Salish Balak, from our Chief Financial Officer from UBI. This morning, I will be providing a review of UBI's financial and operating performance over the past 6 months, as well as giving you a broader update on the market opportunity for UBI's products and our strategic priorities for the business for the remainder of the year and beyond. And we will be taking questions at the end of the presentation. We will be referring to the half-year results presentation lodged with the ASX yesterday. And I would like to start on slide 3 by first touching on the financial highlights from the first half of 2018, before I get into further detail on the financials during the course of this presentation. In the 6 months to June 30th, 2018, quarterly service fees paid by UBI to UBI by our global partner in the blood glucose market, LifeScan, increased to $12 million, or 5% compared to the prior comparable half in 2017. Strip revenue paid to us by Siemens for the coagulation strips we manufacture for their Expressus Stride device fell to $900,000 in the half compared to $2.3 million in the first half of 2017. I will talk to this further in detail shortly. However, at a high level, this is a result of inventory buildup in the Siemens supply chain that occurred last year, with strip volume and revenue continuing to be sequentially lower until Siemens gains meaningful global market share. As a result of these impacts, UBI's total revenue for the half were $13.5 million, down from $14.3 million in the prior corresponding half. EBITDA also fell in the half to $1.7 million compared to $4.9 million in the first half of 2017 due to increased expenses mostly related to development for the next generation Siemens product. I will talk to the reasons for this as we proceed through the presentation. UBI continues to generate positive cash flow, and over the half, it was these cash flows that supported our increasing investment in new product development. In addition, our cash balance continues to improve, and net cash closed at 30 June 2018 at $11 million. This is after taking into account our $15 million U.S. debt obligation to Ethereum Capital, which is payable on 1 July 2019. Turning to slide 4. Recent events. This slide highlights the key events that have occurred in the first half of 2018. It has been a very active first half with significant developments that have affected both of our international healthcare partners, LifeScan, a Johnson & Johnson company, and Siemens Healthineers, as well as some internal developments here at UBI. On Friday, 16 March 2018, LifeScan announced that it had received a $2.1 billion U.S. buyout offer from Platinum Equity, a Los Angeles-based private equity fund. This was not unexpected. Johnson & Johnson, LifeScan's parent company, had publicly disclosed since early 2017 that they were exploring strategic options for the LifeScan business unit. Then, following a review period on 13 June, Johnson & Johnson accepted the Platinum Equity offer. Platinum Equity has publicly stated they expect the transaction to close by the end of the calendar year. I will talk to UBI's blood glucose performance shortly, only I want to highlight these important events to our shareholders upfront as they could have impact on our business. In the fourth quarter of 2017, UBI received in excess of $45 million U.S. quarterly service fees from LifeScan, and therefore, under the master services and supply agreement that exists between UBI and LifeScan, LifeScan has the option to buy out its obligation to pay quarterly service fees to UBI. At this stage, LifeScan has given no indication of their intentions with respect to the quarterly service fees. You can rest assured that we will immediately update the market if we have any material communication with LifeScan or if the transaction proceeds to closing with the new owner's Platinum Equity. Additionally, our other global partner, Siemens Healthineers, with whom we have a collaboration agreement to supply test strips for their Expressia Stride coagulation analyzer device, is also in a period of corporate transition. The Siemens Healthineer division, which houses Siemens imaging and laboratory diagnostics businesses, was separated from the broader Siemens conglomerate via an initial public offering listing 15% of the business, which is totally valued at 28 billion euros on the Deutsche Börse on Friday, 16 March. The IPO of Siemens Healthineers was 2 times oversubscribed, and since listing, the share price has traded around 38 euros, well above the IPO offer range of 26 to 31 euros. The parent company, Siemens AG, retains 7 of the 11 Siemens Healthineer board seats. It's very interesting that our 2 global business partners went through major corporate events on the exact same day, with the Siemens IPO and the Platinum Equities offer to buy LifeScan, both occurring on 16 March. Finally, from an internal UBI perspective, you will have seen via our ASX announcements in April that Mr. Gary Chambers, Vice President of Technology Development, and Dr. Alistair Hodges, Chief Scientist, resigned from UBI. Both Gary and Alistair have been with UBI since the company's inception, and I'd like to thank them for their service. Alistair and UBI have agreed to a consulting agreement under which he will provide ongoing consulting and advisory services to UBI as required. Moving to the next section on products and services, let's go to slide number 6. I will start with an overview of UBI's blood glucose monitoring performance. In the first half of 2018, blood glucose strip volumes increased 5%, linked to ongoing growth in the global diabetes management demand. Quarterly service fees paid to UBI also increased by 5% in the first half of 2018 compared to the first half of 2017. Interestingly, you will note from our Appendix 4C that in Q2 2018, the quarterly services fees paid to UBI were favorably impacted by the Australian dollar to US dollar foreign exchange rate and increased 9% comparable to the prior quarter. Overall, we maintain our guidance for quarterly service fees are expected to grow at 7% for the full 2018 year. As I just said, aggregate quarterly service fees received by UBI exceeded $45 million US dollars in late 2017, and thereby LifeScan, or assuming the transaction proceeds to closing, their expected new owner, Platinum Equity, now have the option to exercise their right to buy out the quarterly service fees paid to UBI. If LifeScan or their new owners do exercise this option, they are obliged to continue to pay quarterly service fees for the balance of the applicable year in which such notice is given, and pay a one-time lump sum calculated at 2 times the quarterly service fees earned for the full year in which the notice is given. Based on this, we estimate the lump sum payment to be in the $40 to $45 million range if exercised this year, and if this is not exercised until after the completion of the Platinum acquisition, say in early 2019, the earliest it could be paid is 2020. If LifeScan or their new owners do not exercise the option, the quarterly service fees will continue to be paid to UBI into 2019. Moving to the next slide, slide number 7. As you are aware, UBI has partnered with Siemens Healthineers that has enabled our company to access the global warfarin monitoring market, otherwise known as PT-INR market, for blood-thinning coagulation drugs such as Coumadin. As you can see, the coagulation testing revenue has been volatile, and now I will talk about this market and some of the reasons for this in more detail. Expressia Stride PT-INR coagulation test strip volumes sold to Siemens fell in the half, reflecting depletion of existing supply chain inventory purchased last year and the nature of the competitive market landscape within the global coagulation testing market. We expect low sales to continue in this market until Siemens gains more meaningful market share. I will talk to the broader coagulation market dynamics in more depth as we move through this section. From a UBI perspective, we continue to focus on production efficiency and cost reduction in our manufacturing process to support Siemens with price concessions to improve their market share and thereby increase our production volumes. This is essential, as our margin contribution is effectively zero, only to be achieved by UBI's internal cost reduction efforts. The manufacturing process is designed to easily scale up for low-cost production and volume is necessary to improve margins. This must change. Siemens Expressus Stride device uses test strips that we produce in both the professional setting, such as in hospital, and in the ambulatory settings, including clinics, GP offices, and specialist offices, such as cardiologists. Roche Diagnostics is the dominant market player in this segment with an estimated 90% worldwide market share. In broad terms, we estimate around half the global spend in this market occurs in the U.S. Then breaking this down, roughly 80% of the U.S. market is in the ambulatory setting of clinics and doctors' offices, which requires the FDA's CLIA waiver for access. The CLIA waiver is a U.S. regulatory requirement that relates to ease of use of the testing device. The waiver represents that a lower-trained user can successfully operate the device, such as in a doctor's office setting, as compared to a pathology lab. The current Siemens Expressus Stride does not have the CLIA waiver, which means Siemens cannot access this market segment. However, the goal of the second-generation product currently in development with Siemens is being designed to meet the FDA requirements for a CLIA waiver. For the Stride product, additional clinical trials and regulatory submissions are required for a CLIA waiver, and this is not planned because the next-generation product is already in the preclinical stage. Another factor affecting market penetration in the professional coagulation market is Siemens' ability to access market opportunities. The professional in vitro diagnostics market is characterized by contract lengths ranging from 4 to 5 years or even more. This means typically as little as 20 to 25% of contracts turn over in any 1 year. Then, once a tender is won, that business is unlikely to become available for another 4 to 5 years. This means the market share gains will be muted by institutionalized purchasing practices. Added to this, there can also be supplier incentives and concessions so that contracts are renewed without being put out for tender. I thought this is important to outline the commercial parameters underpinning Siemens' market share situation. Recent actions with Siemens include, first, ongoing discussions regarding our product profitability and UBI's R&D expenditures for the next generation product development, as this must change. Having these discussions is required with a partner as we are both in this together. Second, and in addition, we implemented initiatives related to our ongoing joint development work with Siemens and the need for our efforts to be structured as one team working toward one set of project goals. Initiatives introduced in the first half of the year to support this include the setting up of a combined project steering board meeting for aligned project updates. These meetings are jointly attended by Siemens and UBI senior management. Also, we restructured and reorganized the project team in April. We believe this integration between the teams and realigned responsibilities create a better project plan with more schedule and budgetary accountability. It's all about the go-to-market timeline. And with that, let me move on to slide 8. I would now like to present an illustrative medical device development timeline from concept to post-market. I found investors often ask me questions about timeframes in the medical device development area, and I want to share the key phases required to take a device from concept through to market and the steps and indicative timeframes required to progress through each stage. On this slide, I've attempted to give timeframes for each of the key development and commercialization stages, and as you can see, these timeframes can be broad ranges. A quick progression from concept or feasibility to product launch could be in about 3 years or as long as up to 6 years. As in-house case studies, the LifeScan Vario blood glucose analyzer and the Siemens Expressus Stride analyzer and test strip, for example, are in the post-market phase. The development for the Vario started with the J&J agreement in 2007, and then in 2011, LifeScan received U.S. FDA 510K clearance, so a 5-year time frame to global launch. Similarly, the Siemens development agreement was signed in 2011, and then the Stride analyzer received U.S. FDA clearance in 2016, so a 6-year time frame. So both of our internal case studies fit within the generic time frame. Now, UBI's current products in development being the second-generation Expressia Stride coagulation analyzer in conjunction with Siemens, as well as UBI's in-house coagulation device and test strip, which was restarted in this half, are both currently in the development and preclinical phase on the timeline graphic. And most steps in this phase have either been completed or they are in progress. This will be explained in more detail later when I provide the update on our FY18 priorities. I would now like to talk to the first half 2018 financial results in further detail, and just a reminder that UBI's fiscal year ends on 31 December. Now, turning first to the P&L on slide 10, at the revenue level, I touched on the key trends up front, and revenues from blood glucose, which represent the receipt of quarterly service fees by UBI, increased 5% half on half. Revenues from coagulation we received from Siemens were affected by inventory buildup in the prior period and subsequently declined in the half. Revenues from HRL, although small, are growing, and we continue to focus on growth opportunities for this business. Looking at the expenses, our COGS relates to the manufacturing cost of the coagulation strips for Siemens. We have no COGS associated with our blood glucose revenues, as they are received in form of fees, and as there is no associated manufacturing cost, so they drop straight through to gross margin. We have increased our investment in development in the first half of FY18, as I've already touched on, and I will talk to this more specifically in the next section. General and administrative expenses have also increased in the period primarily as a result of one-time separation payments made to staff as part of management staff reduction and other initiatives to reduce expenditures and contain costs. Again, while the separation payments are one-off and not a continuous expense, they were necessary to reduce our ongoing expenditure run rate. At the bottom of the table, you will note we've included a reconciliation back to EBITDA. Again, the negative trend half on half reflects the volatility in revenue from our coagulation strip sales to Siemens, as well as increased expenses mostly related to our increased development investment in the half. Now turning to the cash flow on slide 11, we continued to deliver positive operating cash flow over the half, even after increasing our development investment as UBI ramps up various development tests for Siemens in relation to new and alternative coagulation products which are being designed to expand functionality and penetration in the point-of-care coagulation market. These development tests are required as the coagulation product advances toward regulatory clinical trials. In addition, as previously indicated, UBI also recommenced work on our in-house proprietary PTNR self-testing device and associated test strip, leveraging existing partner-funded development activities. Management remains committed to control expenditures based on revenue available to spend within the current capital structure and investment prospects. This control includes cost reduction efforts such as over 20% Rowville full-time staff reduction over the past 9 months. We are focused on managing the business to maintain our cash generative position, and our expenses we incur are managed in this regard. The quarterly service fees received over the half, even after our expenses and investment, delivered operating cash flow positive. We used a small amount of cash flow to invest in the upgrading of our manufacturing equipment to reduce COGS on the strips, as discussed earlier. Cash flow used in financing relates to the fees charged by lenders for maturity extension. Given the weakening of the Australian dollar over the half, we report a cash flow benefit given our U.S. dollar income flows. The chart on the bottom left provides a cash reconciliation over the past 12 months. An important feature to note is a positive impact the R&D cash rebate had on UBI's cash generation over the period. As many of you would be aware, the federal budget in May of 2018 introduced new R&D tax incentive rules, and these are briefly summarized on the right-hand side of the slide. Given UBI's revenues are expected to be in excess of $20 million in fiscal year 2018, this means UBI will no longer be eligible for a cash refund and instead will receive a non-refundable tax offset based on R&D intensity. We would anticipate that our R&D intensity will be at the higher level of the categories identified and therefore could expect to claim a 12.5% tax benefit above our applicable tax rate today. Moving on to our balance sheet on slide 12. Due to our cash flow performance, UBI has increased its closing cash balance as of 30 June 2018 to $31.1 million, including $3.2 million of restricted cash. I won't go through every line item of the balance sheet. However, I will draw your attention to some changes. The term loan of $15 million US outstanding to Ethereum Capital is due on 1 July 2019, so that has now been classified as a current liability rather than non-current. The deferred revenue line relates to the prepayment of various Siemens milestones. This will be realized as revenue once those milestones are achieved. Now turning to the final section of the presentation, strategic considerations. I'd like to give the market an update about UBI's strategic position and where I see the strongest opportunities for the company, starting with the business strengths on slide 14. As already mentioned, UBI has a proven track record of commercializing early-stage technology and being able to translate this into revenues and earnings for its shareholders. UBI has significant skills, experience, and know-how that it has developed through the commercialization process of its two test strip products in the blood glucose and the coagulation markets. The company is also experienced in working through regulatory processes and developing clinical trials to satisfy these processes. Additionally, UBI is ISO 13485 certified for both coagulation and blood glucose, which is a stringent international quality management standard for medical devices. UBI has over many years worked with partners and co-funded development activities. This has also led to significant knowledge which I believe can be leveraged to generate new business opportunities for the company. The acquisition of HRL provides the company with customer and product line diversification, as well as the potential to increase the revenue base through further penetration of services in new market categories. In 2017, we completed the HRL post-merger integration following its December 2016 acquisition, thereby fully bringing the business into the UBI group. While the external revenue is small and consolidated in other services, our plan for 2018 and going forward is to implement business development actions to grow current and new customer revenue to transition HRL from a cost center to a profit center in the midterm. The other key element of strength for UBI, as I see it, is the strong financial position it has created. Its cash balance and operating cash flow provide flexibility. And finally, the board and shareholders are closely aligned to achieve the same objectives. That is, we are all working toward the same goal to deliver value for UBI shareholders. Now, given our company's strengths and foundations, I'm focused on opportunities for the business outlined in slide 15, where we can generate more value for our shareholders. We are actively undertaking discussions with potential partners in new geographic markets, new segments such as the patient self-test market in the home, and with potential businesses that offer a complementary product offering. New commercial opportunities that meet our shareholder return criteria and utilize the internal know-how built up over the years of medical technology development are being assessed. Our staff and management have the experience of the regulatory process as well as clinical trials and quality requirements for medical products. Broadening our relationships with other healthcare industry participants is another avenue I am committed. UBI is a credible business partner at top-tier level, having worked with the likes of LifeScan, the J&J subsidiary, and Siemens Healthineers. Our specialist manufacturing capability is another asset we would like to leverage, as scale-up may offer the opportunity to deliver new income streams. Our operating cost discipline will be continued, and the opportunity for additional cost savings will continue to be explored while ensuring internal quality standards are maintained. UBI's cash balance is growing thanks to positive cash flows that have been generated in recent quarters, and the board and management will continue to consider and explore capital management initiatives over the next 6 to 12 months with discipline paramount. More detail will be communicated with shareholders as the board makes decisions, such as the implications associated with the possible LifeScan lump sum payment, should we receive notice that they will exercise that option, and including taking into consideration the outstanding $15 million U.S. loan that remains payable to Ethereum funds. Finally, I'd like to highlight to investors that in order to pursue value creation for UBI shareholders, we are increasingly evaluating inorganic growth opportunities, joint ventures, and partnerships that are complementary to our business and beneficial to shareholders. This initiative is a counterbalance to losing the R&D tax incentive rebate and the lower Siemens sales. Now turning to our FY18 priorities on slide 16, I'd like to run through what we've achieved in the past 6 months in the context of the priorities I outlined to you in February. First, we have completed preclinical studies and encouraging results and confirmed our next generation PTNR test passes our internal toll gate for meeting FDA expectations. Next, we have identified clinical trial sites in the USA and Canada and will now be proceeding with qualification, training, and contracting. The site agreements will be entered into shortly before starting clinical trials. As for our U.S. FDA pre-submission for our patient self-test product, this pre-submission was completed and we've received initial guidance for our regulatory strategy with good feedback. Further written communication will be ongoing with the FDA to confirm our regulatory strategy is heading in the right direction with the regulatory bodies. Another major step is that we completed the first prototype hardware build and loaded the initial software release for the patient self-test device. The next priority from a financial perspective, we stand by the 7% guidance we've provided in terms of annual quarterly service fee growth. For managing expenditures, we've implemented company-wide cost reduction initiatives such as over 20% head office full-time staff reduction over the past 9 months. More generally, we are bringing a greater cost sensitivity and accountability to the business. And as I just discussed on the opportunity slide, we are looking at inorganic growth options that aim to offset the loss of the R&D tax incentive rebate and low Expressia Stride strip revenue from Siemens. On the Stride cost reduction efforts, since January, we've been undertaking cost reductions to reduce G&A and also manufacturing process improvements to reduce strip manufacturing costs. This supports our goal to improve market competitiveness and support Siemens' market share growth. Our efforts are ongoing, and I see further steps being implemented through Q4. In manufacturing, we are on track to complete the manufacturing verification and validation for our next-generation PTINR coagulation products in the second half of FY 2018. As well, we will complete operational qualification and process qualification, which validates our manufacturing equipment and planned manufacturing process. This work commenced in the first half, and I can report it is progressing very well. Finally, at our hemostasis reference laboratory in Hamilton, Ontario, Canada, we are increasing customer engagement and effective August 1st, implemented a leadership change within the Canadian organization, appointing Ms. Judy Rubin, a new highly credentialed general manager with over 20 years' experience in laboratory operations and business development with contract research organizations and pharmaceutical companies. We will continue to drive to grow this business and transition to profitability in the midterm. While I know many of you on the call will be familiar with the information on slides 18 and 19 in the appendix, I want to briefly touch on some of the key movements in our corporate profile over the period. In terms of UBI's market capitalization and share price, they remain at the same general level as earlier this year when I presented the full year results, and at levels, in our view, that reflect uncertainty about the future direction of the Siemens Healthineers business to gain market share. I want to take this opportunity to thank our shareholders for our support of the company, and we are pleased to welcome institutions with new, substantial holdings onto our register in the past few months. In conclusion, my goal with this presentation has given you additional insight into UBI's financial and market position, as well as potential growth challenges and opportunities available to the company. I'm now happy to take any questions you may have.
The first question today comes from Charlie Williams of CVC. Go ahead, please.
Morning, Rick. Thank you very much for the update. It was much appreciated. Just a question about the milestone payments from Siemens and looking at the deferred revenue. I note that there's another $700,000 in deferred revenue, and just wondering if there are any further cash payments under the restructured and amended agreement from Siemens, looking at the development plan going out the next 12 months.
Yeah, so Charlie, there's not anything additional that has been added, to the current agreement. It would be executed as contracted. However, what I will also add is, as I mentioned in some of my commentary, that we are having ongoing discussions with regards to Siemens on both our profitability and also for R&D expenditures associated with the next generation product that's in development. So while there's no change in that, I see this as part of the overall context of what we need to engage with in someone who's considered a partner, and those discussions have been underway for some months, as you might expect, and as I outlined in my discussion.
Okay, thank you.
Thank you. The next question comes from Brent Mitchell of Veritas Securities. Go ahead, please.
Hi, Rick. Just one question. You talk about forming new alliances with outside parties and looking at outside products. Given the timeline that you've outlined in the presentation, what stage would you be looking at those sort of products or developments?
Okay, yeah. Good morning, Brett. So what I really expect that we need to have some action, in the next 6 to 12 months. The time frame. The discussions that are taking place, for geographic expansion, for joint ventures, different initiatives that have been undertaken over the past month. We need to be able to find if some of these are going to move forward in that kind of a time frame. The inorganic growth option is something now that I think realistically needs to be considered for UBI, given that we crossed over the $20 million in revenue, which then lost the R&D tax incentive rebate, and also to see that the Siemens revenue, our sales to Siemens have not been developing in this last half. Take a more serious look, and that's why I brought this up to bring this forward to the market at this point in time. But and that's why I'm talking about the next 6 to 12 months as to something that I think we realistically need to try to achieve.
I suppose the question that follows that is, anything you do, are you looking at a further 6 years time frame, or would you be looking at somewhere that's further advanced or something that's further advanced along that time scale?
Only those that are further advanced. I think that the past history at UBI with investment in what I would call research, not even in development, is indicative that we need to approach this from a different strategic orientation, and so either in market or near market, and also something that we could potentially already leverage that we have in house. And so these are the kinds of, and what I would say is leverage existing assets to deploy them in a new and different kind of way that have been considered in the past, applying the creativity. And so this is why I think it's got to be something that is more long term, or short term, not long term in its prospects.
So you're still talking about the basic technology of strips and a meter, or moving beyond that?
Well, I think it could be both. I don't think they're mutually exclusive. I think that the strips and the meter are assets that we currently have in our product portfolio. So that certainly is a platform to expand upon. And then I think we have HRL Laboratory, which has a different set of customers than what we have today, and it's also service line versus a product line. And our new general manager that we've hired there in Canada is intended for that. And then I think also there could be adjacencies that are associated, with what we have from an experience and skill and know-how standpoint within the company. So to answer your question, I think it's both, and they're not mutually exclusive.
Okay, thanks.
Thank you, Mr. Legg. Actually, we've just had one pop up from William Ward, private investor. Go ahead, thanks.
Yes, good morning. Just in regards to the LifeScan agreement, the termination clauses, there's no concern with the new ownership they're going to cease that business?
No, I don't think that they would be ceasing the business. Their investment is $2.1 billion US, and of the products that they have on the market, there's the Vario and then there's the Ultra. The Vario was developed and designed, by UBI. It is the market leader amongst those two products, more advanced. So our expectation would be that they will continue to drive Vario placements and sales, and so I don't see that they're exiting the market would be a possibility at this point in time. I mean, Salesh, would you want to add any comment to that?
I think they're paying a huge price, $2.1 billion, and I think it's realistic to assume that they're buying earnings base of the LifeScan business, so they will continue the business.
And as a private equity firm, we would also expect, that they will try to, operate as a financial investor, which I think expectations versus a strategic buyer. And so I think that they will continue to try to drive that sales up and, which prospectively, would consume then more strips.
What percentage roughly is the glucose, the Vario of their business now? Would you know?
We don't have that kind of information, and it's not been disclosed even in their financial reports what the breakdown is between those two.
Right, but what, 50-50, 60-40?
I really cannot comment. I don't have any market information or data to answer your question.
So having a private equity firm, controlling that business, towards the end of this calendar year, they would be more likely to, make the decision to pay out UBI, would you imagine?
Well, I think that our expectation, it changes compared to when, if the transaction closes compared to when J&J owns LifeScan today. And with J&J, we could see that once the decision was made for a strategic change on the diabetes business overall, which now J&J is in process of exiting the entire diabetes business, having closed down their insulin pump business and transitioning that to Medtronics, and then recently selling off their insulin patch business. Then the last component for this strategic transition at J&J is to sell off the LifeScan business. And so with I think with the changes that were underway from a strategy standpoint within J&J, that making a decision on exercising the buyout would have been a lower priority, given that they may want the subsequent buyer to make that decision. So now, as a private equity firm, I think that the probability would be higher than what it was with J&J. However, they still have to go through the closing and then make a decision individually on what they want to do. So we haven't received any kind of information either from J&J or LifeScan or Platinum Equity, and we would engage with them at the appropriate time frame when the chance to open up discussion with business partners commences. And then we would have a better, I think, idea. However, from our point of view, what's most important is the planning. That we have plans we've got plans sitting prepared to understand what the implications are of receiving the buyout, from the tax consequences for the company, the implications associated with the capital management structure, and I think we can only work within what we can control, and then what's out of our control we can plan for and have the right strategy in place for implementing that once that decision is made.
Yes, thank you.
Absolutely. Thank you for the question, Ryan.
Thank you. We just have one further question from Brent Mitchell of Veritas. Go ahead, please.
Yes, guys, just a follow-on from that question. Given the age of the Ultra and as it doesn't meet accuracy standards in the EU, are you seeing any phasing out of that totally by LifeScan, or are you seeing additional Vario meters being developed?
So I don't know on the development side. We don't have insight into what they're doing on the R&D side. And then, Platinum Equity, they call themselves an M&A and O, private equity firm, which is merger, acquisition, and operation. And so, at least what they would outline is, their interest in potentially, additional development. Now, whether that means product development or market development or cost reduction, it's hard to say exactly what form that may take, or maybe it takes all of those forms on that point, Brent. And with regards to the Ultra versus the Vario, you're correct in, that the Vario is a better performing product, meets the EU requirements, and I think that has been a major factor of why it's been able to gain market share and the success that LifeScan has realized, as well as the success that it's brought to UBI. We can see, from their financial statements, that they've had some business decline in the U.S. However, it's hard to break that apart because it also includes, the insulin pump business and the insulin patch business, and then, you could expect maybe that competitive pressure and reimbursement pressure is, market by market, by country, so you really can't know, you can't, have a wide brush to talk about something on a global basis. And as such, the Vario product, I think, would have a better opportunity to uphold, its position, given that, it's got the European market, and thereby underpins, I think, a more favorable position from a cost standpoint on both the cost of goods sold for both the analyzer and then also for the strips.
Okay, thanks.
You're welcome.
Thank you. There are no further questions at this time. I'll hand back to Mr. Leglater for closing remarks.
Yeah, thank you, Jane. So I think that we've really have had some important actions in the first half with both the change in corporate transitions that have occurred with LifeScan and with Siemens Healthineers, and likewise with some of the restructuring that has gone on within UBI, and with our project development activities in coordination with Siemens. And I'm looking forward to continuing on this path, for the rest of the fiscal year, and have further progress to report to the market, our investors, when we continue the updates for the full year. So thank you for calling in today, and thank you for those of you that also fielded the questions. And I think that's it from Rowville today. Thank you.